Welcome to the Oanda MarketPulse Market Snapshot. My name's Craig Erlam, Senior Market Analyst at Oanda. Now, as you can see, there's been a lot of economic data out already today. We've had Chinese manufacturing and non-manufacturing PMI. We've had the RBA rate decision on employment data from the Eurozone, Germany and Italy. Manufacturing data from the Eurozone and Germany, UK, and more to come from the US today. But really, at a time when, or in a week when we've got such massive economic events still to come later on this week, these data points do tend to have a slightly lower impact. We do tend to see people sitting on the fence a little bit more, taking a little bit more caution. And that's because, well, understandably, yes, these manufacturing PMI surveys, they are important. They do provide important insight into what we can expect from future activity. But for one, they are largely in line with expectations, slightly better in some cases, slightly worse in others. They don't really change the fundamental outlook as far as many people are concerned. Whereas we think of Thursday and Friday, we've got the ECB on Thursday, expecting them to cut the deposit rate further, potentially to minus 0.4% from currently minus 0.2%. Potentially going to increase the asset purchase facility as well from 60 billion to 80 billion euros. These are substantial economic events that can have a big bearing on the markets. On Friday, we've got the US jobs report. Always a big economic report every month, but when it comes a couple of weeks before the Fed is expected to raise interest rates for the first time in almost a decade, then it comes with increased importance because people will be looking to this report for further confirmation that the US economy is in a suitable position in order to raise interest rates. Now, one of the things I did want to touch on is the RBA statement. Now, while the other data, of course, is important, the RBA statement I thought was very interesting, and it has a role to play in what we saw in the Australian dollar overnight as well, and over the last 24 hours really. In the Australian dollar, we did actually see it get well supported, and the reason was that the RBA is showing a less dovish tone, I guess. The reason why is they do believe that they are seeing improvements in the economy. The interest rates are, of course, already extremely low. I do believe they are worried about things like the housing market in some cities as well, and therefore they don't want to provide too much stimulus. And when you're seeing signs that the economy is starting to turn around, they don't really have the need to cut interest rates any further at this stage. I think they'd rather wait and see how things play out. Now, I do think the economy is still weak. I still do think the economy is transitioning, having been so reliant throughout the financial crisis on its mining, on its mining and exports markets, and I do think we are therefore going to see another interest rate cut next year. But what we've learned overnight is that it's unlikely to come in the next few months, and again that has led to Australian dollar support. And I'll actually show you this chart right now, because you can see that we've actually seen the Australian dollar rally over the last couple of days. Now, what I did highlight previously is that we had the break above this descending channel, and that was just a couple of weeks ago, this descending channel which is traded in for a little over a year now. And I said from the start it wasn't very convincing because we saw this break, and rather than see this aggressive move higher back towards these previous highs, of course I wasn't expecting all in one day, but rather than see a move back towards these previous highs, it appeared to stall almost immediately. We saw a mild move out, and then all of a sudden we saw it retrace back to within the descending channel. Never a good sign for what is typically quite a substantial breakout. Now, of course, it did close back above the descending channel, but again, when we saw another rally in the pair, it reached only around 50 pips above its previous highs, and then all of a sudden we were seeing a retracement again back towards these 71.50 to 72 levels. Again, not really that convincing a rally, but what we've seen is a bounce off that 50% Fibonacci retracement level, which I'll show you on the 4-hour chart now, from the lows on November 18th to the highs on November 25th. We saw it pull back to the 50% Fibonacci retracement level, and then from yesterday we have seen it rally strongly again on these more or less dovish comments from RBA Governor Glenn Stevens and the RBA statement overnight as well. Now, we've seen it surpass these highs. Yes, of course, we are seeing it consolidate, but 73 is a key psychological level, and as you can see on this hour chart as well, it is a previous notable level of support and resistance. So it's no surprise that we've seen it stabilize around here, but I do think this is just consolidation, and we are possibly going to see it push back towards these 73.80 to 74.30 levels in the not too distant future. Now, another chart I wanted to highlight is copper. I wrote a piece on this yesterday, and it is an interesting chart right now because we have seen extreme amounts of selling in copper, but that doesn't appear to be over at this stage. We have reached two $2 a pound in copper prices. Now we are seeing it consolidate. Now there's suggestions that this may potentially be the start of a reversal, but you can see that this is very much looks like more like consolidation. Looks like a flag pattern here, which is a bearish continuation pattern. Now as it stands, we've had 2 touches on the upside and a 2 or 3 on the bottom, so it's not really confirmed as a flag setup yet. But if we see a break of this, the lower bound, the channel support or the flag support, then I would expect to see that $2 per pound level come under pressure once again, and below here further support could then be found around 190. So really the signals are suggesting that while this is of course has seen some extraordinary amounts of selling over the course of this year, potentially further downside is to come. The final chart I wanted to highlight is cable or sterling against the dollar, and that's because we saw it break below these lows yesterday, the lows from November 6th, and it found support around 150. And again, that's not really a surprise. It's a key psychological level, 150. Also, prior level of resistance in March and April, prior level of support at the start of this year. So it's no surprise that it found support here once again, even though it only broke below the previous support by around 25 pips. Now, what we've seen is we've seen it retrace slightly off of this rebound, but then it's run into resistance around 150, 120. And if we can see the 4-hour chart here, you can see that this does look like a reversal setup now at these prior highs of 150, 125, which was the highs back on the 25th and 26th of November. It does seem to have reversed off this level, a long upper wick and a big red body. I would like to have seen it close below the previous candle's opening levels, but we didn't see that. But what I think is interesting on the 1-hour chart is the fact that we've got this big bearish engulfing pattern. So that is a very bearish setup here, and I do think we could potentially now see cable put more. We could see more pressure on the 150 level in cable, and if we see a break of that, then we could be looking back towards 148.50, which again is a previous level of support. For more in-depth news and analysis, check out Oanda Market Pulse at MarketPulse.com. You can also find out more about Oanda and sign up for a free demo account at Oanda.com. Here you'll also get access to Oanda Forex Labs, which has a lot of great tools aimed at helping you in your trading.